The income statement, the cash flow, and the balance sheet tell a story about the financial health of your business. Without this knowledge, you'll be in the dark. Hey, who turned out the lights? Cash flow outlines how much money is coming into your business and how much is going out. It forecasts what's in your bank account at the end of each month and may indicate if you need a business line of credit or a loan to stay afloat.
As I always say, cash is king. Without it, you can't pay your bills, you can't grow your business, you can't pay your employees, and most of all, you can't pay yourself. When you understand cash flow, you know where money is coming from and where it is being spent. The cash flow statement is a record of the amount of cash and cash equivalents that flow in and out of your business for a specific period of time. This is usually for a period of 1 year, but it can be for other periods of time as well. This is why the cash flow statement is such an important tool for entrepreneurs. It shows you a change in cash over time, rather than the cash you have at a specific time. This is usually on a month-to-month basis. This way, you can predict with some accuracy when you will have enough cash and whether you will have enough when you need it. You should be able to answer these two key questions at all times. What is my cash balance right now? What do I expect my cash balance to be in 6 months? Make sure to check back and update your cash flow statement frequently throughout the year. It is important to understand you can look great on your income statement with huge profits, but yet have nothing left in the bank. If this is you, your business won't survive. Without cash, profits are meaningless. You need to realize that credit sales are not the same as cash sales. You need to monitor your cash flow so that you don't find yourself short of cash during lean months. The cash flow statement provides us with the vital information we need to avoid this. You will likely extend credit to your customer when you first start out. Try and get a sense of the customer's ability to pay bills on time. If they are a business, do a credit check. Are they having cash flow problems? Instead of extending store credit, make sure you accept all major credit cards. It's a safer bet that you will get paid on time. Ask your customers to pre-authorize checks so that banks can draw against their accounts at timed intervals. Offer your customers discounts if they pay their bills quickly. This may impact your profit margin, but may improve your cash flow. You can also use this tactic with your suppliers. Limit your credit sales when you start your business. Too many sales on credit at the start will result in you increasing the burden on your accounts receivable. This makes you cash poor. Do all of your banking at one bank. Focus on customer service to ensure repeat business. Those initial customers will provide you with cash to start running your operations effectively. Overemphasizing customer acquisitions at the start doesn't put money in the bank when you will be needing it the most.
The cash flow statement, like any of the other financial statements we are covering, begins with the items at the top of the first page. The company name, the title, and the year that we are looking at. We will be looking at the cash flow for the whole year of 2015 in this demo. The cash flow statement is divided into 3 sections. Cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. The cash flows from operating expenses section reports on earnings that are directly related to the operations of Jen's Bakery. Thus, Jen has cash receipts from her customers for baked goods and for the rental of her party room. This is a positive cash flow. Her operations require that she pay her suppliers for things like raw materials, deliveries, cell phone, internet, etc. This is a negative cash flow, indicated here with the use of brackets. Jen also pays for rent and utilities. Jen's net cash flow from operating activities is a positive cash flow of $9,555. The cash flows from investing activities section reports on investments that Jen is making into the business. Typically, for an entrepreneur, these are fixed assets. For example, equipment is a common one. Jen's old baking oven broke down and she decided to purchase a new one. Currently, this is a negative cash flow. For now. It can become a positive if she decides to sell the oven in the future. As a result, Jen's net cash flow from investing activities is $4,500. The last section, cash flows from financing activities, reports on how Jen has financed her company. Typically, a new business will finance through a bank, a financing company, using their own money, or some combination of these. Anytime Jen makes an investment into her business by using her own money or through borrowing from a lender, it is a positive cash flow. Cash is going up. Whenever she pays money back to a lender, it counts as a negative cash flow. Cash is going down. If Jen decides to draw cash from the business for personal use, this is also a negative cash flow. All three sections can have activities taking place throughout the year, and it can result in a positive cash flow or a negative cash flow. When we total up all of Jen's cash transactions related to activities in 2015, we will either end up with a net increase or a net decrease. In this case, Jen has a net increase of $3,780. At this point, we look at Jen's cash balance at the beginning of the year. We add her net increase to this to calculate her ending cash balance. Now that you have seen this simple example of Jen's cash flow statement, you should be able to fill out your own.
The balance sheet will show you what a company owns, its assets, and how much it owes, its liabilities. It's a quick snapshot of how much your company is worth.
Your balance sheet is a statement of the assets, liabilities, and equity of your business at a particular point in time. The balance sheet indicates the company's financial position at a particular point in time, usually the company's fiscal year end. It allows you to see what the company owns and what the company owes. As a shareholder of your business, you'd be interested to know what assets you have available to you in operating your business. Cash indicates the balance in your bank account. Accounts receivable indicates the amounts that your customers owe to you. Inventory indicates the goods that you have available for sale. Fixed assets indicate the value of furniture, machinery, and equipment that you use to provide your goods and services. Accounts payable indicates the values of bills and invoices that you currently owe to your vendors. You'll also see government liabilities like sales taxes, payroll taxes, and corporate taxes. The long-term debt section will show the amount of money that you've borrowed for purchasing capital assets and working capital. If a company has been consistently profitable, it will have more assets than liabilities and will show equity in its retained earnings. If a company has more liabilities than assets, it'll show a deficit on its balance sheet. This may be a sign of financial distress and that the company may be failing. The balance sheet makes up part of the financial statements, which every company should have prepared each year by a chartered professional accountant. Shareholders of a company will use the balance sheet to understand whether their business is growing over time and accumulating more assets. Creditors use the balance sheet to evaluate a company and its eligibility for financing. The balance sheet doesn't tell you about the revenue and expenses of a company for a fiscal period. Every balance sheet should be accompanied by a profit and loss statement which represents the revenues and expenses of a company for a fiscal period. Also, many of the accounts on your balance sheet will have explanatory notes which will appear at the end of your financial statements. These notes give greater details regarding the account balances, including the details of fixed assets or the repayment of long-term debt. Your financial statement should be prepared at least every year by a chartered professional accountant.
Let's take a moment to revisit what the balance sheet is about. Simply put, it shows the value of what the business owns, the amount of debt the business has, how much inventory is on hand, and how much money the business has to work with in the short term. Let's take an example. The balance sheet allows Jen or a potential lender to quickly get a handle on the financial strength and the capabilities of her business. Assets are generally listed according to how quickly they will be converted into cash. Current assets are things a company expects to convert to cash before one business year has been completed. In this case, Jen has some cash, some accounts receivable, and some inventory. The total current assets are $8,980. Jen also has some long-term assets represented by her equipment. This is a fixed cost, which means it is not expected to be converted into cash until after 1 year. We also account for the depreciation of this equipment. At this point, we can calculate our total assets. Liabilities are generally listed according to their due dates and can either be current or long-term. Jen's current liabilities are accounts payable that she owes and salaries for the current pay period. These are expected to be paid within the year. The total current liabilities are $1,850. She is also carrying some long-term debt as well. It is the total of the outstanding balance she has to pay on her 3-year loan agreement. We can now total all of Jen's liabilities. In order to calculate her equity, we use this formula. Assets minus liabilities equals equity. In this case, $17,730 minus $12,050 equals $5,680. When we add our total liabilities and our equity together, we get $17,730. The two sides balance, and we are done. Now, you try it.
It's important to get into the habit of updating these statements regularly. Not only is this discipline required when running your business, it will also have you properly prepared for key moments, such as filing your taxes or if you decide to sell your company. After planning your business, designing your marketing, and implementing your operations, your financial statements will give you the ability to make key decisions to keep your doors open and your lights on. Thank you for watching our video series on learning how to start your business. We hope it was of value to you. Please feel free to contact Futurepreneur Canada to help you with your business startup. We are here to help you with pre-launch coaching, financing, and mentorship. You can find us at www.futurepreneur.ca. Thank you again to the Province of Manitoba for making this video series possible.